Real estate investment practice problem using OneNote. Lender-induced early loan repayment calculation. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon, left-hand side, Practice Problems tab, down in the 6081 Lender-Induced Early Loan Repayment tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Presentation, also in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closed in the icon, got the information up top, calculations on down below. Scenario being, we have the fixed rate loans. And let's just first kind of review the advantages and disadvantages of the fixed rate loan. If the rate is fixed, then of course it's not going to be fluctuating as the market fluctuates. And that would be good in the event that rates go up. So you've reduced the amount of risk with regards to the fluctuation of the market. The main risk on the downside being that rates then go up over time. And if you had a variable rate, then you could experience, an increase in the rate. If you locked down or fixed the rate at that point in time, you're looking good because your rates will remain the same. Payment should generally remain the same. And in essence, you're paying off the loan with dollars that are worth less due to inflation. If, on the other hand, the rates go down on the market side, you still have the fixing of the rate, and your rates are not going to go down as they would possibly in some adjustable rate type of loans. However, you do have the option under those cases to determine whether it would be worthwhile to refinance, as we looked at in prior presentations, measuring the costs of refinancing to the benefits in lowering the payments due to generally the lower rates. Now, on the upside, if the rates go up and you have a fixed rate loan, then there might be something that you can do still to kind of benefit yourself, or the lender then might try to induce you basically to pay off sooner. The concept there being that on the lender side of things, if the rates increase, then you're paying off your loan at a rate that is less than what they could get elsewhere if they were to make new loans. Therefore, they might have an incentive to try to induce you to pay the loan off sooner, try to convince you to pay the loan off sooner, or give you some benefit in order to pay the loan off early. In so doing, they get the money sooner, and they can then make new loans at the higher rate, which would be more beneficial for them because they'd be making the interest on the higher rate loans. So bottom line, if you're in the fixed rate, if you got the fixed rate loan, the rates could go up or down, and there may be something that you could do either way in order to get some benefit possibly. If the rate goes down, then you got the refinance you're thinking about. If the rate goes up, then the lender that you're working with may then want to induce you in some way to kind of pay off the loan and possibly give you incentives to do that. So let's consider that situation. So we're starting off with the $100,000 loan. We're not going to put anything down or anything here because we're really just focusing in on the loan amount of the $100,000. The years are going to be 30 years, and we have the months then are 360, which is 30 times 12. We're going to say that it was 6% when the loan was taken out. That then is fixed. So we fixed the loan at the 6% rate. And then we're going to say after years have passed, we're imagining 1 year has passed, then we have the rate has increased to 7%. So we're looking okay then because we locked in the rate. That was a good move in that instance because now our payments will remain the same, whereas if we had an adjustable rate, the rate might increase to something like 7%, right? So it's fixed at 6, but the market went up to 7. But now the lender might be saying, hey, if I can induce you to pay us sooner, possibly give you some benefit to pay us sooner, I'd like to get the money back sooner so I can lend it back out at the higher market rate, which is the 7%. So our current payments we're imagining are the 599.55, which is representing the 6% rate, and the information up top using the PMT calculation, total payments then calculated on down below. So if we look at our amortization table, we're imagining we started this out with a $100,000 loan. The payments then at this about $600 rounded, interest being calculated at the 6%, not the 7%. It's not going to fluctuate. It's fixed. Then at the end of 1 year, we're at the 98,772 at that point in time. So now we're going to imagine that the bank has incentive to try to get paid back sooner. And obviously you, as the borrower, are okay with the loan at this point in time because you're getting financing at a rate less than other people could get financing at that point in time. So they'd have to give you some kind of benefit, possibly, in order to induce you to say, hey, yeah, maybe I'll pay you off sooner to do that. So let's kind of think about what the bank's incentive would be on that side. So this is a fully amortized loan, of course. So we can try to say, okay, what would be the market value of, in essence, the loan? In other words, if the lender can get the stream of payments that you owe to them back at this point in time, what would be kind of like the present value of that stream of payments? In other words, you owe, it's almost easier to see in a kind of a cash flow basis at that point, right? You owe the stream of payments, which is about $600 for the remaining of the 29 years. If we were to value that back at the current discount rate, then in essence, what would the value of that be? We know when we look at the amortization table, the loan balance is at, after 1 year, scrolling all the way back up, the 98,772. But we know that the current discount rate or market rate is 7%. So what would be the value of the stream of payments at that rate, in essence, at the 7%? So we can do this a couple different ways. We'll use the present value calculation, and then we'll also value it with the IRR, which is a little bit more intuitive possibly to understand and giving us that double check by looking at it both ways. So we're going to do a present value calculation, pulling kind of like the stream of payments into the current time period. It's going to be the present value, brackets. We're going to pick up the rate. Now, the rate we're going to use is the market rate now, the 7%, not the rate that's being used for the amortization table, the 6%. That's a yearly rate, so we're going to divide it by 12. Then we're going to say, comma, the number of periods. I'll think about it in years first, and then multiply it times 12. So 1 year has passed. We take the 30 up top minus the 29 years, and then multiply that times 12 to get the number of months. And then we're going to be picking up the payment, the stream of payments that we have. In essence, we have an annuity of around $600 to $599.55. That means that if we look at this stream of payments, the $599.55 for the next 29 years monthly payments at the rate of the 7%, we present value that stream of payments, we're at the $89,201.56. Now we know the actual loan value at this point in time is actually $98,771.99. That's what the actual loan value is, but you're going to be paying off the loan at the 6%. So in other words, if the bank was able to get you to pay off the entire loan at this point in time, at the $98,771.99 minus the current market value of the stream of payments, they would have a benefit, of the $9,570. So in other words, if they can get you to pay off your loan, the $98,771.99, and they were valuing the stream of payments, it's valued at the $89,201.56. So in present value terms, then in essence, they would be making $9,570 because they would take this money, the $98,771.99, and then lend it back out, supposedly at the higher rate, the 7%. So you could see then the bank then has an inducement or an incentive possibly to give you an incentive in order to prepay the loan, which could be beneficial on both sides so that you could pay the loan off sooner and possibly get some benefit from the bank to do that. Now, how the bank might structure that incentive could differ and so on, but the basic idea is the bank then could have some incentive to try to induce you, give you some benefit to pay the loan off earlier so they can get the money sooner, and then they can take that and reloan it out at the higher rates. And this, if the whole amount was repaid at that point, you can kind of see what the benefit to the bank would be, so you can get an idea of what possibly their benefit would be, and then see what kind of offers or see what kind of things they might be offering in order to get the repayments, so you could see if that would be worthwhile on your side. So for example, we can do this also with like a cash flow type of calculation, an IRR calculation. We're basically just going to prove this calculation up top that we figured. So in other words, if we valued this loan at the $89,202, let's say that basically you paid if you paid $89,202 in order to receive this series of payments, which is your mortgage payments of the $599.55, about $600 for the remaining years, which is 29 years times 12 for the number of periods. And we were to take this and we were going to say, okay, so I'm going to pay the $89,202, which we figured up here, and then I'm going to receive these payments back, the $600 on the loan, and we valued this all the way down. We'd have the total of the $119,442 over the 348 periods, which is 29 years times 12. And then if we took the IRR calculation, the rate at which this series of payments would be zero, it would be 7%, right? That's where so we're backing into that 7%. It would be valued at that 7%. So we're basically just double checking this calculation that we did up top with the present value calculation to determine the value of this stream of payments, verifying the fact that the bank then has an incentive to try to get the money back sooner at that point. Again, general idea so that they can re-lend it out at the higher rate and make more money on it, more interest.